In this video, we're going to talk about the two different kinds of stocks that you want to purchase. One is value and the other is growth. Those are the two best kinds of stocks to add value and make money in your portfolio. So let's look at how to determine if a stock is a good value. And I'm going to look at Coca-Cola, and we're here on Yahoo Finance, a very good place to research stocks. Now, in the left column, this is where you can go to research. We want to go to the income statement. Stock prices are always based on how fast a company is growing. So we want to look at the top line. We can see that in sales, Coca-Cola is consistently growing, a little bit more all the time. Let's go down to the earnings. That's the key point that we want to look at. We can see that Coca-Cola is growing. It went from $8.584 billion to earnings of $9.019 billion. And I already did the calculation. That's an increase of just over 5%. So that's not bad. It's not a fast grower by any means, but it's pretty steady. More people around drinking more Coca-Cola, me for one. So this is a steady stock. So let's look at how the price is relative to these earnings that you are buying if you buy some of this stock. And you can do that by going to the key statistics right here. Now, for the trailing 12 months, that's what the TTM stands for right there, the trailing PE ratio for Coca-Cola is $21, or rather 21, for a stock that's priced at $40.52 a share as of July 5th, 2013. Okay, so Peter Lynch in his book, One Up on Wall Street, talks about how it's a really good value and a good buy if you purchase a stock that is the PE ratio is lower than the growth rate in the earnings. If it's higher like it is here, then this is an expensive stock and you're taking on too much risk to buy it. Okay, remember the growth rate was 5% in earnings and the PE ratio here is 21. So this is not a stock that I want to buy. It's too expensive. What I'd really like to see is a growth rate in earnings of, say, 20%, and then a PE ratio of 10. Now, that would be a great buy. I'd buy that. But Coca-Cola right now, I don't want to buy it. There's too much risk and not enough reward. You know, at some point, the stock market is going to come down because there are always bear markets that are going to happen. A value stock will protect you from losing very much when they come, when the bear markets come. So this is something to keep in mind. I actually did some searching and I couldn't find any really good values. You have to search a lot to find a really good value. That's what Warren Buffett does all the time. He sits around and researches stocks until he finds a good value. That's how he finds them. You got to put a lot of work in to find them. So that's how you determine if a stock is a good value stock. Now let's look at growth stocks for a minute. I'm going to go to Priceline.com. How do you know if a company is a growth stock? Well, because it's growing fast in its earnings and its sales. So let's look at this. From 2010 to 2011, Priceline went from $3 billion to $4.3 billion. It's a pretty good growth rate. That's about a third, 35% or so increase in sales. It's pretty fast. From 2011 to 2012, not quite as fast, but still growing at a pretty good clip, especially for such a big company. Let's look at the earnings. Down here, it went from $527 million in 2010 to over $1 billion in 2011. That's almost double. And then a 40% or so increase to 2012, $1.4 billion. This company continues to grow fast, and let's see if that shows up in the stock price. Look at that. This is a 1-year chart. 1 year ago, you could have bought it at $6.50, and here it's at $8.50. So that's a 25% or so increase in 1 year. That's great. And let's see what it's done over the last several years. Wow. You could have bought it 5 years ago for around $100 a share. Now it's at $8.55 per share. That is what a growth stock will do for your portfolio. 8 times your money in less than 5 years. Very nice. Okay, the problem with this stock is anytime there's a loss in the growth rate, the growth slows down, then boy, you're going to take a hit, and because the stock price is going to go down very fast, very, very quickly, very far. Just like you see, this is just a normal pullback right here, and it went from almost 800 down to 600, over $100 drop. So very volatile, but still in the long run, very profitable. We can go back even further and see you could have bought it and held it even earlier and bought it for $50 a share, or see what it was down here. Oh my gosh, $30 a share in 2006. 7 years later, more than 10 times your money. That is a fantastic return in spite of a drop in 2008 to 2009 during the recession, going from 135 down to more than a 50% drop right here. It doesn't look like it in hindsight, but it is. More than a 50% drop right there. So how do you find a stock like this that's growing fast? Well, usually you just have to pay attention and go to Yahoo Finance News, because growth stocks are always talked about on a regular basis. Everybody's paying attention to them. Apple, Google, Priceline, LinkedIn, Facebook, maybe in the future. These are the kind of stocks that are going to be growing fast, have huge potential, and you just hear about them and check them out, and they can be a very good purchase for you. Now let's look at their key statistics for Priceline. Okay, we saw the recent increase in earnings was about 40%. The trailing PE ratio is 29. So actually that's a pretty good deal, as long as the company continues to grow this fast. Excuse me. If they don't continue to grow that fast, doesn't matter. Stock is going to take a big hit. So you have to consider the outlook for that company. What do you think, this stock can continue to grow as fast as it has been in the future? Very critical component for growth stocks. So these are the two main stocks that you want to buy. You should have some of them in your portfolio. This also helps you to determine when it's time to start selling stocks, when those PE ratios go well above the growth rate in earnings. That's when it's really gets to be time to start lightening your load on stocks and getting more into short-term bonds or cash. So anyway, I hope that helped, and make sure that you catch the next video, is the most important one of all. Okay, thanks for joining us, and have a great day.